all those capital gains magically disappear. So, if your parents paid 100 grand for their house that's now worth 2 million, when they pass away, that $1.9 million gain disappears and you get it at the 2 million valuation. You can sell it tax-free. Welcome to Wealth Creator Radio, where we help people overcome the uncertainty of having enough retirement income. I'm your host, Eric Heckman, a certified financial planner with over 30 years of experience. We want you to enjoy life and not have to wonder where your money will come from and how long it'll last. My mission is to show you how to develop a personalized income plan so you can retire more and have worry less wealth. Here at Wealth Creator Radio, we cut through the noise and get straight to what matters. We understand that the world of retirement planning can be filled with confusing products, ever-changing tax laws, and volatile markets. That's why we're here to help successful people like you navigate the uncertainty and create a blueprint for a thriving, work-optional life.
Welcome to Wealth Creator Radio. With the market volatility in the news, many retirees are thinking about the parts of their retirement income strategy that do not rise and fall with the market. And so for many of the retirees, that means Social Security. So Eric Heckman is here today. Of course, he's founder and president at Heckman Financial. He's going to share with us ways that you can get the most out of Social Security, especially in an unpredictable market. So let me start off by giving you our phone number. You'll need that today. We want to make sure that you have it so you can contact Eric and our awesome team at Heckman Financial. That number is 800-454-1184, 800-454-1184. You may call that number. You may text the word visit to that number. You may also text the word toolbox to that number. And you can get the digital toolbox that Eric is offering you today. We're going to be talking about that a lot. So again, that number to either call or text is 800-454-1184. And remember, our website is wealthcreatorradio.com. Eric, so excited to be here with you. We've got a lot to talk about, don't we?
Yeah, well, with the market instability has been crazy. And this is not like previous times in the market where we've had, bad times, right? We've had .com crashes where people were overly valuating, how great some of these companies were. We've had the financial crisis, where mortgage meltdown, Lehman Brothers going away. This one's all just policy related. So in a way, I guess we could call this self-inflicted, but it's in a way, it's very anti-capitalistic. Free markets are supposed to be stuff where they're free, right? They supply and demand. And now we're saying, oh no, this country has to buy this much of our stuff, and this country has to buy this much of our stuff. Well, there's other countries. We're not the only, only person out there. So, you've already seen China doing deals with, getting rid of Boeing contracts, buying beef from Australia now versus the US. And so, it'll be interesting to see how this all plays out and down the road. I think we're going to really see how this really plays out probably by the fall, because of that's when we're going to start seeing it in earnings reports. That's when we're going to see it in other stuff. Seeing a lot of companies already cut back on tourism, or not tourism, but travel. And then of course people are cutting back on tourism. And so I think one of the first ones to fall will be definitely the travel industry, and all that, and hospitality industry. So,
right.
And if you're retired, this is kind of a really rough time, right? Because you can't wait for the market to come back. I mean, if you're working, you're in your 40s, 50s, this probably won't be a big deal. It will be a blip, back, when you look back on it on your 401k, right? But for people that are retiring today or already retired, you can't just say, oh, I'm going to wait for another year or two before the market rebounds and take my money out. It's like, no, you've got to get that money today.
Right.
And once you spend some of that money, once you cash in those shares will never come back because you just spent them, right? Yeah. Paid
That's
the bills
so
with them. So.
Yeah. How can Social Security then be that lifeline for retirees when the markets do drop?
Yeah, I mean, hopefully it's not the entire lifeline,
Yeah,
right?
I know,
But
just a little.
but at least having one set of stable income is good. Now, Elon, who knows what he's going to do with it, and he's not even been elected, as far as I know. But he's still got a lot of power somehow. He's going through there, and then there hasn't been any way to really protect Social Security because we've got a big deadline coming up that's been there for 20 years, and it used to be a long time from now, and now it's about 9 years out is when Social Security is not going to be able to pay their bills. But right
Mhm.
now, yeah, at least it's some sort of stable income. But I think really what happens is people need to have one other source of stable income that's not government based.
Right.
That's tied in with insurance companies where they can have a pot of money, you can earn some great interest, withdraw the money as you need it, and know that one's not going to go away. So yeah, the more foundational base income that you can get coming in, you're just going to be a lot more safer than having to cash in stuff when markets are down.
Eric, you and your team at Heckman Financial, you help people determine the right time to claim Social Security for their situation. Talk about how Social Security fits into your overall retirement income plan that you use for retirees.
Yeah. So anytime we're doing the income plan, really one of the biggest things to do is figure out what's the best time to turn it on. Lots of times people now are going, "Oh, I should just turn it on now, right away, get it before it runs out," and all that stuff. And you got to watch out, right? There's some rules if you're under full retirement age, which for most people is under age 67. If you're under that age and you turn it on and you're still working, you might give it all back and lock in the penalty for starting early. So that's what you don't want.
No.
So that's one of those things that you have to really, really watching for. And, really what you want to do is look at it in context of an overall plan. Because lots of times she'll say, "Oh, you should wait. Oh, you should start sooner, blah, blah, blah." And they're just all guessing. And then what they'll do is they'll compare Social Security dollars to Social Security dollars, which is nice, but not really the point. So a lot of people still retire at 65. So if you retire at 65, you need income every single year. Well, if you wait till 70 to turn on that Social Security, that's 5 years of not getting payments, right?
Yeah.
And that's a long time. That's a lot of money that you did not get. Now you might have more Social Security dollars by the time you're 80 or 85, but did you actually have a higher net worth? And to me, looking at your higher net worth, comparing the net worth at 80 or 85, that's the right answer of when to turn on Social Security. And ironically, about two-thirds of the time, it's actually start sooner. It's
Yeah.
not wait. And most people
Interesting.
say, "Oh, wait, 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 you'll get more money."
Yeah.
But that's because you burn through so many assets to get there, to wait there. So, one of the great reports that we do have in that digital toolbox is, the Social Security timing decision. When should you turn it on? Will my money last as long as I do? Kind of side by side, good reports to read, and
Yeah.
they're both about 10 to 15 pages. They're not long reports to look at and stuff. So really quick, easy to read. And then you can also get a copy of my book, Worryless Wealth, or you can even set a time to talk with me, Eric Heckman. So all you got to do, super simple, is just text word toolbox to 800-454-1184. Again, text word toolbox, 800-454-1184, or download directly at wealthcreatorradio.com.
And we thank you so much for joining us today. This is Wealth Creator Radio with my friend Eric Heckman of Heckman Financial. We're talking today about Social Security and ways that it could be an even bigger asset for retirees during a market downturn. And one thing I want to touch on before we have to take a break, Eric, is what should people know about spousal or survival benefits?
Yeah, so survivor ones that's for widows, and the weird part about that is it's only different age. You can actually technically start that at 60. The nice thing is it doesn't affect your personal benefits, which is great. However, it has that same work restriction. So if you make more than 22,000 or 23,500, they're going to take back your Social Security payments that you get. So does it help for some people? But yeah, you have to be fully retired to do that, or not work much. So that one's a little bit less effective, I find. But definitely, if you stop working, say at 65, yeah, you could turn that one on and then flip to your own at 67, or something like that. So there's some fun games you can play with that, and some good math that we can do to figure out which way is better. For the spousal, it's really, what happens is this one's very confusing. Lots of times people think they get half of their spouse's Social Security if they didn't work as much. And that is kind of true. They get half of their full retirement age Social Security. So
Okay.
if that spouse works till 70, they don't get half of the 70 amount. They get half of what it would have been at 67. So yeah, I
Gotcha.
find a lot of people mess that one up. And
Yeah.
and so again, this is super easy in a income plan. when we meet with people, we kind of go over this and we can figure out what's the best solutions, what's the best options. But again, it always comes down to that awful word planning, right? Yeah, you got to have that plan, right? And so, yeah, so that's something if you want to get a little bit more information about the Social Security timing decision, how to make sure money doesn't run out, or last as long as you do, I should say, or set up a time to talk with me, Eric Heckman. All you got to do is text the word toolbox to 800 454 1184. Again, text word toolbox 800 454 1184, or download directly at wealthcreatorradio.com.
If something's worth doing, it's worth doing right. There's a particular time of life this phrase couldn't be more appropriate. How can you know you'll live the retirement you've always imagined? After all, life can be so unpredictable. You've worked hard and saved. Watch your accounts go up and down with the market. Your advisor says, don't worry, you'll be fine. But you still don't feel confident. Eric Heckman at Heckman Financial has a checklist to help you find out if you're on the right track for retirement. If you can check all the boxes with confidence, you may be ready for retirement. If not, Eric can help you address any potential costly mistakes. To get Eric Heckman at Heckman Financial's complimentary checklist, call or text LIST to 800-454-1184. Call or text LIST to 800-454-1184. Firm offers insurance services. Investment advisory services offered through Heckman Financial and Insurance Services, Inc. Investing involves risk, including the potential loss of principal.
Hello, I'm Lou Ann Fulmer here with Eric Heckman. Thank you for spending part of your day with us today. You might think that estate and legacy planning are just for people with, big mansions and big bank accounts, but you need to think again, because estate planning is actually preparing for life's curveballs that could happen in retirement, preserving your wishes and having a plan for you and your loved ones, no matter what you have in the bank. So, Eric, let's talk about that. Let's talk about why estate and legacy planning are important for everyone, regardless of your financial situation.
Yeah, so I mean, we all have an estate. It's our junk, right?
Yeah.
who, who gets
Yep.
all the junk that we collected, and maybe some people don't want it.
My daughter does
Um,
not want it. I will tell
yeah, a
you
lot,
that.
lot of the stuff people don't want anymore. That's for sure. But usually the financial assets they don't mind getting, right, and stuff. So I always kind of just jokingly tell clients that it's a ton of work if the state is in order, and it is a massive undertaking if somebody's estate is messed up.
Yeah.
Messed up meaning that you didn't tell people what you wanted. You didn't put any good beneficiary designations, or you didn't put stuff in a trust, or even have a will, or any sort of direction. And it's one of those weird things where even if you don't have a lot, there can be some weird fights. I mean, I've had some weird ones. I had for a while there, I had a 4 generational client, which was kind of cool.
Wow.
And when grandma passed away, one of the kids went in there and their daughter took some of grandma's shoes. And before the other one had chance to look at grandma's shoes. Now, I'd known her for a while. She didn't have any fancy shoes that I noticed, but literally they started fighting over grandma's shoes. And
Yeah.
I mean, just sometimes it can be silly stuff like that, right? Sometimes there may
Right.
be some sentimental, stuff that you probably wouldn't even be able to sell at Goodwill, but maybe grandma painted that, or that was something we have had in the family from, whatever.
Yes.
It may not have much, you can't go on antique roadshow and get a lot of money for it, right? Or praise for a lot, but it might be something that, might mean to a lot to somebody. So that's one thing I think that people need to do. Obviously, the financial side is another whole thing. I mean, just getting that ready in the right spots, and often it's not the kids that have issues. It's a lot of times the kids' spouses that all of a sudden kind of throw into the mix and say, "Hold it, you should have gotten this, or you deserve more." And yeah, it can get ugly. So
Yeah.
you definitely want this taken care of.
So, okay, I want you to tell us some more specific stories, a couple common problems you've seen when an estate plan is outdated or just non existent. If you can give us some specifics about that.
Yeah, I mean, there's a couple different things. Well, one was actually when my own uncle passed away. My aunt had been, they'd been both worked in a GE at a plant together there for in New Mexico and stuff.
Uh-huh.
And when he passed away, she found a bunch of GE actual shares in a
Mm,
desk drawer.
What?
And
Oh my.
yeah, yeah, and a lot of those were bought before they even got married. They'd been married for 25 years. So
I know what you're
this
gonna
has been
say.
this has been in a desk drawer for a long time,
Oh,
and
no.
so some of the beneficiary on that was actually his brother who had died 10 years before him. So,
Oh, wow.
even though they had a trust, even though they had all their estate planning done, because he forgot this one, literally, desk drawer, um, that, and it was a lot of money. I mean, it was kinda like about 6 figures worth of stock there, and
Yeah.
it was first they had to prove that the brother died, then they had to prove that she should get it, and then they could finally sell it. Well, sadly, this was GE stock that was going down during that time
Mm.
frame the whole time. So the ending value when she was able to sell it was a lot less than
Aw.
had it been just, been able to get out of it right away,
Yeah.
or even knew she had it.
Yeah.
So that's one thing, is just making sure all the accounts are in the right title, that they're, I mean, hopefully people don't have the old school share certificates. They've stopped issuing those. So, and then, the other problem is sometimes people just don't get what might happen. They may have set it up right, but don't fully get, or say some rules. Because probably the one I remember the most was, this was probably about 10 years back, is I had a client that, there was 4 siblings and the parents passed away and they each got, one quarter of the house. The house back then was worth 800 grand. And one of the siblings was just going through a divorce, needed a place to live. The other one needed a place to live. So the two of them moved in. And the other two that are expecting 200 grand checks go, well, hold it. What about our buddy?
Oh, yeah, they're not getting it
And,
now.
and now you're at a 50-50 split, right? So
Yeah.
there's no winner, on this case, right? So, and they had to wait for the divorced sibling to finalize his divorce because he couldn't go get a new loan on the house and pay off the other ones. But he finally did after about 3 years. But
Oh, wow.
if you're expecting 200 grand and then you have to wait 3 years to get it,
Yeah. Oh my
it's not
gosh.
super fair. And so again, that's
Mm-mm.
something where maybe you could write in there, what's the timelines or what's the rules, or do you just have to sell it? Or, if somebody,
Yeah.
put some more stuff in there to make sure it goes the right way. But, again, that's why we have some educational materials set up at our digital toolbox. And, so we've got some great stuff about not only estate planning, but will your money last as long as you do? Are you paying too much money in taxes and retirement? You can even get a copy of my book, Worry Less Wealth, or you set up a time to talk with me, Eric Heckman. All you have to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or download directly at wealthcreatorradio.com.
And we thank you so much for joining us today. This is Wealth Creator Radio with Eric Heckman. I'm Lou Ann Fulmer. We're talking about estate and legacy planning, and it is pretty complex. And I think Eric's so complex that a lot of people just don't know where to start. What would be some of the major points people would need to consider to start addressing right away?
Well, the simplest is just making sure your beneficiaries are correct, right? So,
Mhm.
or accounts that don't typically have beneficiaries, add them. So 401ks, IRAs, life insurance, annuities, all those things have to have beneficiaries. So hopefully you have one. Hopefully it's
Yeah.
a right one. I would make sure you have first and second beneficiaries, because say if it's you and your spouse and you both get killed in the same crash or whatever, you want to know who gets it next, right? So you want not just the first but the second beneficiaries. But the other ones, bank accounts. Bank accounts can have a thing called POD, payable on death, and that's like a beneficiary designation. If it's a brokerage account, you could do a thing called transfer on death, and that's a TOD. So don't ask me why one uses payable, one uses transfer, but same thing in the end.
Yeah.
And so that just says who gets those funds when you're gone. And so that's a super simple thing. That's no lawyer involved. That's just, nowadays most websites can, you can just log on and do it. So,
Yeah.
so that's a come on, you got to be able to do that at least type of thing.
Right.
And
Yeah. Yeah.
but beyond that, really, I mean, once you have real estate, that's the tough one. Real estate, you can't really put those designations on. So that's when you really want to have a trust, and then you need to move the assets into the trust. So that's when you're meeting with an attorney. Now, it doesn't have to be a ton of money. You can, do some of these online ones, do some other stuff. So, if your situation is pretty simple, then yeah, maybe you don't need a lot. But just taking the time to make sure you have it set up, that's probably one of the most critical things. And I think that's one of the things that people forget.
Right. And obviously, it's not a one size fits all when you are working with a couple or even an individual. So, do you do something like an estate planning analysis for people when they come in and see you and have questions?
Yeah, so that's one of the 5 areas. So it's income, investments, taxes, healthcare, and legacy. And we just at least tell you, hey, are things in the right spots, or what do you need to do? We can kind of coach you on which types of things you should be looking for. If somebody has a special needs child, or somebody, as somebody with drug and alcohol issues or other things, yeah, there's sometimes where you need a little bit fancier planning. But lots of times, yeah, it can be pretty simple too. So again, it's really more about looking at your situation. It is very individualistic because, yeah, it just depends on what your specific situation is. And then figuring out, okay, here's where we can at least guide you to. We don't do the tax, we don't do the legal documents, but we can at least tell you which ones you need. And then we also help people get them and get all their accounts into those right beneficiaries and everything else fixed afterwards. So again, if you want to get a little bit more information, you want to set a time to talk, copy my book, Worry Less Wealth, or a lot of our other downloads, all you got to do is text the word toolbox to 800 454 1184. Again, text the word toolbox, 800 454 1184, or download online at wealthcreatorradio.com.
Be sure to like and subscribe to Wealth Creator Radio so you can stay up to date on ways to build your wealth and create a retirement you and your family will enjoy for years to come. Like and subscribe today and create your wealth for tomorrow with Wealth Creator Radio.
Hey, so glad to have you along with us today. I'm Lou Ann Fulmer here with Eric Heckman, where their mission is to help you get through a worry-less wealth retirement. So we're talking about estate and legacy planning today. And one thing I want to bring up is that we cannot overlook the fact that taxes are going to play a significant role in estate planning. I want you to discuss the different types of taxes that heirs are going to face when they inherit an estate, Eric.
Yeah, I mean, right now, most people, aren't lucky enough to inherit enough to have a state tax problem. That's up to $14 million now. So,
Wow. Okay.
per parent, right? So,
Yeah, right,
so
right,
yeah, so for most people, that's usually, okay. That one's not, that's not a big deal.
right.
The weird part about the miracle of step up in basis at death, that's the part that people lots of times don't fully understand. So if it's anything that, say a parent, just to keep it easy, it could be a sibling, whatever. If you just own it outright, not in a special type of account, right? So if it's a brokerage account, if it's a house, whatever, all those capital gains magically disappear. So, if your parents paid 100 grand for their house that's now worth 2 million, when they pass away, that $1.9 million gain disappears, and you get it at the 2 million valuation. You can sell it tax free. So
Wow.
so that's a pretty, huge deal. I mean,
Yeah.
years ago I had a client who she worked at this little company in Cupertino as what she called a secretary back in the early '80s, and this company Apple did okay, and her 9 grand became 3 million. Her kids didn't even know they had that much,
Oh my gosh.
and so one time I actually calculated the taxes on it, and it was astronomical. I think it was close to 1 million if she sold it,
Wow. Oh
and
my.
when she passed away, they get it tax free. So pretty
I
amazing.
can't believe that, honestly.
Yeah, and so that's one of the biggest, if you want to call it loopholes or whatever, but
Yeah.
one big huge benefit is after someone passes away. So that's the great part.
Yeah.
The really bad part is all that money in 401ks, IRAs, 403bs, 457s, all those things. Those are horrible taxes. So
Yeah.
those under the Secure Act that came out in 2020, they said, okay, now instead of taking 30, 40 years to spend down this money, you get 10 years. So, if somebody passes away in 2025, you have till the end of 2035 to have withdrawn all that money and paid the tax. Now, you don't technically have to spend it, you could reinvest it, but you got to pay the taxes on it first.
Right.
So, in that case, if your parents had put in 100 grand and they did great investing, it's worth $1 million, you get to pay the tax on the full million. And you have to start taking money out the year after they die, and you have to take it out every single year. And then, like I said, at the end of the 10 years, you have to have it all spent. Now, this is typically when you're still working, you're still
Right.
making money. So this is going to be money on top of your normal tax bracket. So you're going to be, maybe in the 32, 35% bracket then. You're going to be
Yeah.
jumping up way high.
Right.
And you don't have any choices on that. You can't convert it to Roth. You can't do anything special. You can't donate it to charity, other stuff. So a lot of the stuff that you can normally do with IRAs to avoid some of the tax, or spread it out better, none of that's available for you. So yeah, so it's great to inherit those regular assets, the tax deferred assets, the 401ks, IRAs. Those are the worst assets to inherit.
Oh my God.
So
That's when you hope your mother has a $3 million estate that you didn't know about.
yeah, right.
Right? Oh my
Yeah.
gosh. Okay. So a lot of people, they don't want to just build their wealth, but they want to share it, right? Make a difference
Mhm.
in the lives of their loved ones, or maybe even a special charity that they're fond of. Talk about how people can succeed in doing something like this and avoid, these estate planning mistakes that we're talking about, and maybe bring in some blunders that you've seen people make.
Yeah, well, I mean, one of the easy things to look at is if you are trying to sell, especially say some company stock that's gone up really well, or maybe it's a house or something like that, and you're downsizing, you can set up a charitable remainder trust. So this is where you give assets today. So say a stock, highly appreciated, real estate, something, you give that to a fund, and then that fund will pay you a lifetime income. And then whenever you pass away, the charity gets whatever is left over. And so
Oh,
the
so
neat thing is you get a write off today for that future value of that gift. So,
okay. So
so you get a tax write off now, and then you get income.
that's cool. It's not like you're the charity though.
No, no, no. It does
But
have to have the drawback is your kids ain't getting that,
yeah,
right? Somebody else
right.
is getting that. So,
That's
so
good
you don't have to
though.
do all your money, but it can be for a
Yeah.
good part of it. And then again, that means now you got another pot of money that's coming in pretty consistently, and
Right.
so yeah, there's a lot of different options you can do. It's just more about what works for your situation, what makes sense for your situation. What are you trying to change? And yeah, it's just critical to know that. And again,
Right.
that's why if somebody wants to set a time to talk with us, it's super easy. All you have to do is text the word visit to 800-454-1184. Again, if you want to set up a 15-30 minute phone call, we can answer any questions you got, see what makes sense, and then kind of go from there. All you have to do is text the word visit 800-454-1184, or book directly online at wealthcreatorradio.com.
And thank you so much for spending part of your day with us today. I'm Luann Fulmer here with Eric Heckman of Heckman Financial. Eric, a recent survey shows that only about 26% of Americans have actually taken steps to formulate an estate plan. This is interesting. Those who work with a financial advisor are twice as likely to complete an estate plan within the next 2 years compared to those who don't. So, talk about that. Explain how and why working with someone like you, an advisor like you, can expedite the process and help ensure that an estate plan is put into place.
Yeah, I mean, well, it's good that it shows that we're doing our jobs,
Yeah.
right?
Yeah.
So, I mean, it's just kind of think of a personal trainer, right? I mean, if you work with a personal trainer, you're more likely to work out because you're paying them, right? And
That's
you
right.
better show up, or else
You
they're
better.
charging you fees for not showing.
Right, right.
And so, same with a financial advisor. Yeah, once you start working with somebody, again, we don't do the actual documents, but we do make sure, like we have a rule that all of our clients have to have a second beneficiary on everything. We make sure we audit that every time we meet with people, just to make sure every account's up and running the correct way. And if they don't have their documents, other stuff, we'll just keep harassing them and get them to go do it, and until they finally do. And
Yeah.
but yeah, so I mean, I think that is a good sign that advisors, are helping people do what they should do. Because even though we don't do those documents, at least we're getting people motivated enough to get it done.
Exactly, right. So for those people who are listening and they're like, I already have an estate plan, but what advice could you give them to ensure that it's going to be, still effective and up to date?
Yeah, I mean, if you had one before 2010, you definitely want to get a new one because they changed some of the rules and some of the verbiage. So, if it's that old, you definitely need a new one. And I would say about every 5 to 10 years, you should probably update it. the biggest thing, again, I think that people miss is the junk, for lack of a nicer term, but the sentimental items. Who's going to get that? Who should get that? Even asking your kids, is there something specific you want? And then one of the things I actually got from one of my clients who's in his 80s, he went ahead, and his wife, who passed away, had quilted a bunch of stuff, and different people wanted the quilts. So he took a picture of every quilt, wrote down who wants it, and put it in with his living trust. And so it's very cut and dry. This is
Yeah.
the person who gets this when I'm gone. So yeah, with digital stuff, it's super easy. Yeah, take a picture, write it down, put it in with someplace where everybody can find it. And yeah, it's very easy. So again, if you want to talk a little bit about this and more with me, Eric Heckman, all we have to do is text the word visit to 800-454-1184. Again, text the word visit, 800-454-1184, or download directly the link to set up a time at wealthcreatorradio.com.
Imagine for a moment that an intense storm is pounding your house. Will the roof leak? Will the siding peel away? Will your basement flood? If your house is properly built and maintained, you'll be fine. But what about your 401k or your investments? The stock market has had a great run the last few years, but is its current turmoil making you feel uneasy? Are you confident your portfolio is built to weather the financial storm? Now may be a great time to have your retirement plan inspected. Call Eric Heckman of Heckman Financial at 800-454-1184 now. Eric will examine your portfolio and show you if your investments are in need of some weatherproofing. Call Eric Heckman of Heckman Financial today at 800-454-1184. That's 800-454-1184. Investment advisory services offered through Heckman Financial Insurance Services, Inc., a registered investment advisor.
Hi, I'm Lou Ann Fulmer here with Eric Heckman, president of Heckman Financial, where it's their mission to get you to and through a worry-less wealth retirement. Now, Eric gets questions all the time. People find out he's a financial advisor, and they ask him all kinds of questions, probably about the market, probably especially about retirement questions, because there's so much involved there. So I know when you're off work, you probably don't feel like you're really off work, do you, Eric?
Yeah, well, yeah, there's always people to help, and we always try to help them out with that as much as we
Aw,
can.
what a good guy. Okay. Well, we're going to bring these questions to the airwaves today, some retirement questions. So, first question for you, Eric, is from Brent. And he says, I'm a few years away from retirement, but my mind's buzzing about my son. He just landed his first real job after college, and I couldn't be prouder. I'm looking to help him start his career strong without overstepping. Do you think it's a good idea for me to help him set up a Roth IRA?
Yeah, no, definitely. I've got 3 sons myself, so
Yeah.
the definitely the advice to anybody pretty much under 50. So not just only in their 20s, but anybody under 50, all you should be funding is Roth. Roth 401k, Roth IRA. Max out as much as you can. One issue with Roth IRA is there are income restrictions, and so depending on where you are income wise, at some point you may not be able to do it anymore. So that's kind of another reason for somebody straight out of college to be doing it. But the Roth 401k, which pretty much every company has, if they have a 401k, you usually have the Roth option now. And, that's just the normal, contributions that anybody can do. There is no income restrictions. So yeah, the more money you can get out of the government's hands and the growing on your side, it's huge, because if you put in $7,000 into a Roth and it grows to $50,000 at retirement because of all those years it was sitting there, right? That 50 is yours. But you put 7,000 into a traditional IRA, you might save 1,500, $2,000 maybe on your taxes, but now you owe tax on that entire 50,000. And not at today's brackets. At whatever the brackets will be way down the road when their national debt is very likely way, way bigger and larger. So,
right, yeah.
So if you can get it out of the government's hands, this is really for anybody of any age. You can be converting to a Roth. Anybody, there's no more. Since 2010, there's been no income restrictions on converting to Roth, which means you pay the tax now, which nobody likes to do.
No.
But if you can pay the tax at a lower bracket and then have that money grow tax-free for a very long time, again, it's going to help you out. So yeah, go Roth when you can.
Go Roth. I love it. ROTH. So here's the phone number. If you do have questions and you want to come in and see Eric and our team at Heckman Financial and talk to them about converting into a Roth or setting one up, 800-454-1184. That's the number to call. And just so you know, again, if you don't remember, but this meeting is complimentary, okay? Here's another question as we dig into our Wealth Creator mailbag from Jonathan. And he says, I'm thinking about downsizing my home now that I'm retiring. Is it a more efficient choice to buy a smaller place outright or to invest more money and mortgage a new place? Oh, gosh, you probably get this all the time.
Yeah, well, actually, a lot of times I also get, should I not sell my house and just rent it out and then, then have a mortgage to buy another one? Because if you didn't sell it, right, you don't have the cash to buy the new place. And there's pros and cons to both ways. There's obviously being a landlord's a whole different issue and, all those stuff. I definitely, kind of almost specialize on accident in helping move people out of the Bay Area because it is so pricey and expensive. And so, I've got clients that have moved across the state and across the country both. And luckily with Zoom and everything else, they can stay being clients. But
love it.
But it is one of those things that I would say, probably 75-80% of the people who downsize to do this, the whole goal is to not have a mortgage. The goal is just to pay cash for a place. It depends on where you're moving to and what kind of things you're doing. Some people need bigger houses actually in retirement because they want all the bells and whistles and, they want the theater in their house and they want the, huge pool, the big workshop garage, which only comes in with a bigger house, right?
Right.
So, that might be a little bit tougher to do without a mortgage, depending on where you're going and how much equity you got. But I think most people prefer just to not necessarily. It doesn't have to necessarily be a smaller place. I mean, I had a client move from here to Lakewood, Colorado, which is a suburb of Denver, and his house I think is now a 4,000 square foot house just for him, and he sold his 2,000 square foot house here and paid cash for that one, and. So sometimes it's not smaller, but it's still paid off. So obviously depends on how much cheaper the area you're moving to is. So
right, yeah.
But then you have to look at the taxes. You got to look at all the other things. So that's definitely something where you want to get some more advice. You want to set up a time to talk with somebody. That's something we can easily do and kind of give you those numbers and give you those options. But one of the things we have set up here is this digital toolbox that. Not only can you set a time to meet with us, but you can also get a copy of my book, Worry Less Wealth. You can download lots of great little reports that are fast reads, like what's the Social Security dilemma, decision dilemma of when to turn it on. Will your money last as long as you do in retirement? Am I paying too much money in taxes in retirement? All these great things are sitting there waiting for you to be downloaded. So all you have to do is text the word toolbox to 800-454 1184. Again, text the word toolbox 800-454-1184 or download directly at wealthcreatorradio.com.
And we're so happy you're spending part of your day with us. I'm Lou Ann Fulmer here with Eric Heckman, and this is Wealth Creator Radio. We're digging into our Wealth Creator mailbox today. Another question for you, Eric. This one's from Jennifer. She says, I've recently come into an unexpected inheritance. I'm wondering about ways to invest or what to do with this money. Can you guide me on investment strategies that could help me avoid a hefty tax bill?
Yeah, well, let's see. The first thing you're going to probably do is buy a car. That's what almost everybody does when they inherit money.
That's funny, really?
Hopefully not, Jennifer. But I mean, for most people, actually, when you inherit money, it's not typically a large tax bill because there's a magic thing called step up in basis at death, which it means if somebody paid $10 for $100 stock, they'd normally have a huge capital gain if they tried to sell it. But when they pass away, somebody inherits that stock at $100. So there is no more capital gain. Okay. Now, depending, I had one client that they held on to the house to get rid of mom's stuff, and they didn't want to throw it away, so they had to give it away. They promised her they would give it away to other people, and it took almost 2 years just to get rid of all the junk in there.
Whoa. Oh, my.
And the only weird part is the house went up about $200,000 in value. So when they went to sell it, her and her brother both had to pay tax on $100,000 of taxable gain. That had they sold it right away, they wouldn't have had to pay the taxes on the gain, but they wouldn't have had the gain either.
Yeah.
So it wasn't a bad thing, but so for the most part, you don't typically have a tax bill. Now, one thing you have to watch out for is IRA money. Any retirement money is very, very, very complicated now. So depending on when the person died, you may have to take money out every year. You may not, depending on how old the person was who died, who left you the money. But you only have 10 years to spend it typically, unless that person was close in age, like a sibling. And so there's a lot of different rules, but the general gist of most inherited IRAs nowadays are you've got 10 years to spend it. So, when that person dies 10 years later, that money has to be gone to zero. So it used to be you could spend it out over 20, 30 years.
Yeah.
So definitely get some really good advice. Somebody who really knows what they're talking about anytime you're inheriting retirement monies, because of you screw up one piece of paperwork on that and there's no way to fix it. IRS is not nice about that.
Yeah. Dang. Okay. So best thing is for her to come in and talk to you.
Yep,
right.
sure.
800-454-1184. I think I have time for one more question in our mailbag. This is from Jerome. He says, I'm 68. My wife is almost 60. We want to leave an inheritance for our children, but I've heard so many different possibilities. Wanting to know, is life insurance a good way to do that?
Yeah, life insurance can be a great way to do it. It goes tax-free to the kids and such. So the hard part is if you're 68 and 60, it's gotten a lot more expensive. But there are some specialty types of policies where you just dump money in and they kind of work more like a CD, but then there is a death benefit there. So that way, if you need it, you can take it back. If you don't need it, then they get some larger dollars. Those are usually easier to qualify for too. So there's lots of different options with life insurance. It just matters on how much money you have and how much money you can afford to try to leave to the next generation, right? You want to make sure, that you're covered. But one of the best things about most life insurance policies now is they also have long-term care features where you can use that while you're living to pay for long-term care. So it might be a great way to protect your kids from them having to help you, pay for long-term care. And if you never need the long-term care, they just get a good inheritance. So, again, there's lots of different options out there. If you did want to set a time to talk with us, it's super, super easy. All you got to do is text the word visit to 800-454-1184. Again, that's just texting the word visit, 800-454-1184. Or you can book directly online at wealthcreatorradio.com.
Thinking about healthcare costs, long-term care expenses, and income needs in retirement? How will you afford it all? And what can you do now to help ensure your loved ones will be okay when you're gone? Eric Heckman at Heckman Financial has access to tools and strategies that can help you pursue your retirement dreams without taking on too much risk with your money. Interest rates are the highest they've been in decades, so take advantage of this seemingly once-in-a-lifetime opportunity to help protect your retirement before it's gone. Learn about the tools and features available today that could provide bonuses, potentially adding up to tens of thousands of dollars in additional income when medical needs arise. Schedule your visit with Eric Heckman at Heckman Financial today by calling 800-454-1184. That's 800-454-1184. These opportunities won't last forever, so call now to help protect your future. 800-454-1184.
All right, we have come to the time in our show, Eric. I love this part. You give us a story about some retirees that you have helped. Today, you're going to do a wealth success story. It's always a great lesson, to see how things worked out for the best with retirees. So tell us what you have for us today, please.
Yeah, well, I guess talk about Scott and Alex here. So they've been clients for quite some time, and they'd already, before we met, had done a pretty good job of saving up a bunch. And over the years, we just kept doing different planning. We were taking advantage of that mega backdoor Roth, where you can fund extra money into your your 401k after tax basis and convert it. And so that was helping them build up a ton of money now in tax-free, along with the taxable money that they'd been building up over all the years, funding 401ks and IRAs and such. And, they were getting closer to retiring. And, what happens in Silicon Valley quite often happened, and unfortunately, Scott there, and he got laid off. That very common and definitely coming back around a lot more, it seems like now. And so I think kind of post-COVID, they're, a lot of these places overstaffed, and now they're starting to go, okay, who do we really need?
Yeah.
In his case, they got rid of his entire department.
Oh,
so
my.
that was kind of brutal.
Yeah.
And he'd been there for quite some time. So, now the nice thing is that, they give you, most of these companies will give you some nice exit packages. So he did get, several months of pay and all that stuff, but still it was kind of planning on going for a few more years.
Aww.
And I see this a lot where people, they're supposedly not ageism. There's supposedly not issues like that. But, if you're being interviewed by somebody in a hoodie and sandals and you've got gray hair, they kind of know you're older, right? So,
Yeah.
and they're, especially if they're like, wow, you're older than my dad or something like that, not good, they're not saying that out loud, of course, right?
Right.
But mentally they're probably saying stuff like that. And, and so that's one of the tougher things I find is a lot of people end up, getting retired before they planned on doing it. But the nice thing is when we're running the numbers for them that, they can be fine. They're kind of crazy also in the remodel of the kind of like their dream retirement home. So it wasn't necessarily the best time. But, in some kind of silver linings part, well, when you're remodeling something, there's all these decisions, all these things to make. Well, now you're going to have time to go do those,
You'll
right?
be there, yeah.
Yeah, you'll be able to go see them and watch them and stuff. So, so that's one of those things that I think people, in terms of the moral of the story, is really, if you're 60 plus in Silicon Valley, you need to be, ready in case your job changes, right? In a forcibly manner, right? Where you don't have the option. And, and I've seen it so many times, and it's very hard for people to get a job back into that same industry. Now, a lot of times you go off and do a fun job, right? Work at the mountain winery, have some concerts, right? I've got some people working at SAP, enjoying the concerts, the Sharks games, other things, so you could do a job for fun, something that you're interested in. There's lots of different options, but, again, you got to keep those options open, and really figure out what's the best thing for you. But definitely, if you have that planning ahead of time and you're on track and you're on track, if something bad happens, you're going to be okay. Thank you for tuning in to Wealth Creator Radio. I'm Eric Heckman, and it's been a pleasure guiding you towards a more confident and secure retirement. Remember, my responsibility is to always do what's right for you, our client. Together, we can cut out that fancy-sounding financial jargon that doesn't help and focus on what truly matters for your financial future. If you're ready to take control of your retirement planning and build a personalized income plan, contact us at 800-454-1184 and text the word Toolbox to schedule a complimentary consultation. If you're looking for more resources and tools to build your retirement future, don't forget to check out that Wealth Creator Toolbox, your toolkit for a secure and confident retirement journey. Until next time, retire more and worry less with Wealth Creator Radio.
Information provided during Wealth Creator Radio is for illustrative purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal, or tax professional before taking any action. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Individuals should thoroughly review the contract for specific details of the product features and costs. Income payments and withdrawals from deferred annuities are generally taxable as ordinary income in the year they are taken. Eric Heckman offers investment advisory services through Heckman Financial and Insurance Services, Inc., a registered investment advisor. Any tax advice given as part of this presentation is not intended to be used and cannot be used by the taxpayer for the purpose of avoiding tax penalties or promoting, marketing, or recommending to another party any matter or transaction addressed herein. The views and opinions expressed in the program are not necessarily those of the radio station or its sponsors, and they should not construe as legal, tax, or investment advice. You should always consult the appropriate advisor before making any financial decision.